When your income exceeds $1 million, managing wealth becomes a full-time business, even if you don't think of it that way yet. Under landmark rulings like Lender Management LLC or Commissioner Tax Court 2017, high earners now have a clearer path to structure their wealth management like a business and gain legitimate deduction control and intergenerational continuity. In this video, we are going to cover 7 key parts. I will walk you through what a family office is, why it matters now, how it works, client example, the exact step to build one, and what to plan for after 2026, and finally, what the IRS looks for. By the end, you will know exactly how to operate your wealth like a business and use the same system that the ultra high net worth families have been quietly using for years. If you are a high income earner, entrepreneur, or investor making over $1 million a year, this video is for you. Let's jump in. Let's move on to part one, why this strategy matters now. So before we talk about structure, let's talk about the reason this matters. When you hit 7 figures, your financial life isn't just about investing. It's about managing a small empire. You have multiple entities, properties, or investments that will need coordination. If you are not careful, the moving parts can cost you hundreds of thousands in loss deduction every year. That's where the family office concept comes in. So this is the same system the ultra wealthy use to centralize their money, control expenses, and make every dollar serve a business purpose. And when billed correctly, it qualifies as a real trade or business under Internal Revenue Code Section 162, allowing deduction that would otherwise be lost under Section 212 suspended investment expense rules. So this strategy isn't about creating something new. It's about formalizing what you've already been doing and finally getting credit for it on your tax return. Now that you know why this matters, let's move on into part 2, where we break down what a family office actually is, how it's structured, and what makes it legitimate. So part 2, we're going to focus on the framework behind family offices. So here's the truth. The IRS doesn't have a single definition of a family office, but tax court cases and IRS rulings give us the blueprint. A family office becomes a trade or business when it's structured to actively manage family assets, not just hold them. So here are the pillars. It must provide real management service like accounting, operations, investment oversight. It should be set up as its own entity, often an LLC, partnership, or S corporation. It must charge and collect management fees from the entity it serves. It should employ staff, sometimes family members, who perform legitimate work. It should maintain a profit motive, separate bank accounts, and distinct books. If the elements are in place, the family office can qualify as an operating business, and its costs like salary, rent, travel, and professional fees can be deducted as ordinary and necessary business expenses. But this can feel pretty abstract, right, until you see it in action. So in part 3, we will look at an example of how one family turned this from theory into a working system and what it did for their taxes. So let's move to part 3, the Liu family office. So Mr. Liu family from Palo Alto, California, they earn about $3.8 million a year across real estate investment, a consulting firm, and private equity interests. For years, their finances were scattered, like separate QuickBooks files, different accountants, and no unified reporting. In 2024, during the year-end planning, they decided to professionalize their structure. So here, what we did step by step. Step 1, formalize formation, right? So we create the Liu Family Holding LLC. It's a management company serving as the operational hub for all their financial activity. Step 2, service agreements. Each of the family existing entities, their consulting S Corp, real estate LLC, and partnership interests sign a management contract with the new LLC. These contracts define services like accounting, payroll, coordination, financial reporting, and oversight. Step 3, payroll and accountability. There are 2 adult children, one in finance, one in real estate, join part-time to handle bookkeeping and compliance. They receive wages, not distributions, and work under normal job description. Step 4, accountable plan. The family office reimburse work-related expenses, continuing education, travel, and software through a formal accountable plan, keeping no reimbursement tax-free. Step 5, billing and compliance. Every quarter, the LLC invoices the operating entity for services rendered. Payments were made into the LLC separate business account and recorded deductible management fees for managing entities. Step 6, we look at the results. So by the end of 2025, roughly $420,000 in annual coordination costs became deductible business expenses. The family reduced their effective tax rate by 7%, created a clear audit trail, and built a foundation for multi-generational management. Now you have seen how it works in practice. Let's move into part 4, where I will break down how you can start building your own family office one step at a time. So let's move to part 4, how to build your own family office in 2026. If your household income exceeds $1 million and you have multiple businesses or properties, and you're already halfway there, so you just need some structure. So here is the implementation roadmap that you can adopt. So step 1, form the management entity. Start with an LLC or S Corp. This will act as your family headquarters, oversee all investments, accounting, and operations. Step 2, define your services. So decide what function the family office will provide, like bookkeeping, investment, management, payroll, or property oversight. You want to put it in writing. Step 3, draft service agreements. So create contracts between your family office and your entities. So these agreements formalize what's already happening behind the scenes. So turning coordination into billable activity. Step 4, separate books and accounts. Open a business checking account. Track income and expenses separately and keep consistent bookkeeping. Step 5, hire or engage family member properly. So if family members perform real work, pay them reasonable wages, not token amounts. Document hours and duties. This protects the deduction. Step 6, implement an accountable plan. So set up reimbursement policies for legitimate business expenses like travel, conferences, or professional subscriptions. Step 7, you want to show profit intent. So even a small profit margin matters. So this demonstrates that your office is a business, not a cost-sharing vehicle. Step 8, you want to maintain formality. So you might want to hold annual quarterly meetings, record minutes, keep receipts and notes. This is what makes your entity defensible in an audit. So you now understand how to set it up. In part 5, we'll look at how to keep the system relevant beyond 2026 when the current tax rule might shift. The Tax Cuts and Jobs Act provisions that suspend the investment expense deduction are set to expire after 2025. So that means that the landscape will shift again. Here, how to future-proof your family office. Centralize everything. Combine all financial tracking into one reporting system. So this saves hours of reconciliation and reduces oversight gaps. Integrate estate entities. Have your family office manage family limited partnership, trust, and charitable foundations to unify wealth and legacy planning. Consider a C Corp arm for reinvested earnings, or a C Corp subsidy can retain profit at 21%, but always model this with the CPA to avoid double taxation. Go digital. Use cloud-based accounting, digital storage, and compliance dashboards for audit readiness. Educate the next generation. Train your heirs to understand how well taxes and governance work. That's the real definition of legacy. When built correctly, your family office becomes a bridge connecting today's wealth to tomorrow's leadership. Now that we have looked at how to make the structure last, let's move into part 6 and talk about what the IRS looks for when reviewing these entities. The IRS doesn't just examine your paperwork, they look for business reality. So here's what they expect to see in a legitimate family office. First is profit motive. You are trying to earn income, not just offset expenses. 2. Formal service agreements. So written contracts outline services and payments. 3. Active operations. So real work is being done, management, accounting, and strategy. 4. Regular documentation. Meeting minutes, invoices, and financial reports are consistent. 5. Separate accounts and records. No commingling between family and business funds. So when these elements are present, your structure looks and behaves like a real business, which means it's far more likely to withstand IRS scrutiny. Now that you know how the IRS evaluates these setups, let's tie it all together in the final section, where we will recap every major takeaway and remind you how to turn this knowledge into action. So let's recap the key parts of this video. In part 1, we explained why family office concept matter now. In part 2, we broke down the legal foundation. In part 3, we saw how the new family turned into results. In part 4, we covered the step-by-step setup process. In part 5, we plan beyond 2026. In part 6, we walk through what the IRS expects to see. Now, here's your takeaway. The family office isn't just a tax strategy, it's a financial system for disciplined generational wealth management. It turns your scattered financial life into a coordinated business. It gives you control, compliance, and continuity. And it ensures that the wealth you work for continues to work for your family long after the tax code changes. So operate your wealth like a business, document it like a business, and watch how structure turns into freedom. That's how million-dollar earners build wealth that lasts, and how your legacy becomes the business of your life. Thank you for watching. Please like, share if you find the video interesting, and I will see you at the next update.